So I would like to welcome everyone to the Commercial Multifamily Masterminds. We are a member of the GOB network of apartment investors. So I am the host. Alicia Milne is the co-host. And today we have a guest speaker. But what's the mission of the GOB? The GOB network seeks to democratize commercial real estate via mentoring, deal making, and providing the resources to close investment properties and improve returns. What does all of that mean? That to me, that's just a lot of mumbo jumbo, right? What it means is the GOB provides education, network, support, and opportunity for you to get started, for you to get off the couch and to start investing or becoming a GPLP, whatever your goal is. And whoa, why
So,
is
Daryl,
that happening?
do you know who Craig Fournier is? He's the
Um,
only one that doesn't have a mic or a video. So I'm not sure if he's doing that.
so if he doesn't have a mic or a video, boot him out.
I
Okay.
know who Craig is.
You
Oh, you
do?
know who he is?
Yeah.
Now, is that his bot? Hold on one second. Hold on one second. Hold on one second. Hold on one second. All right. So the mastermind mission, our mission here is to get rid of that competitive mindset. It is to bring us all together as one so that we can accomplish more goals, more tasks, more opportunity. We're going to provide the network, we're going to provide the education, we're going to provide the support. Okay. But the most important thing is you need that education. So I want to say welcome to the Commercial Multifamily Masterminds. And we are a member of the GOB network of apartment investors. Okay. The mastermind principle, the coordination of knowledge and effort of two or more people who will work toward a definite purpose in the spirit of harmony. Disruptive thinking. A team is composed of like-minded people with different skill sets, but equal commitment toward measurable outcomes. So what you're going to find here, you're going to find that there are different people with different skill sets. You're going to have cost segregation study. You're going to have lenders. You're going to have GPs. You're going to have people that want to be LPs. You're going to have people of all different backgrounds. Okay, and we need these people. All right, we need these people so that we can help you to get your deal or your investment opportunity. I hate to say deal, your investment opportunity across the finish line. So, as I mentioned, we are a member of the GOB. I'm one of the founding members. I'm a co-founder. So I'm one of the co-founders. That is not a founding. I'm one of the co-founders of the GOB, and I do sit on the board. However, I would like to introduce to everyone the founder of the GOB, Mr. Jim Biggs. Why is this happening here? There we go.
Hello, this is Jim Biggs, founder of the GOB Network. I think most everyone knows that we started the network as a member-driven platform to help more people get deals done. Whether you're a new investor that has no clue how to get started, or you're a seasoned investor and you're just looking for more net worth, liquidity, or other pieces that might be missing from your team. As an example, we recently sponsored a 134 unit deal in Houston, Texas, an 88 unit deal in Tulsa, a 34 unit deal in DFW, a 28 unit deal in Baton Rouge, a 24 unit deal in Dayton, Texas, along with 42 units of self-storage. All of this was with members of the GOB network. And we have many more LOIs, many in negotiations and under contract. These are just a few examples of deals. They came to us and we helped them sponsor that deal. So I just want to use that as an example of what we're trying to do to help everyone that's on the platform. And it's available to anyone. If you're interested, just go visit thegobnetwork.com. Also, I want to say how proud we are of the many faces of the GOB network and the many places that are represented. Thank you for being part of that by being here today. So let me close by saying to you, get on board, because the GOB network can do the same thing for you. Oh, and one more thing. Let me say we are especially proud of Daryl Murphy and his mastermind group, and to have them as part of the GOB network. Daryl is one of the founding members and sits on the board of advisors for the GOB network. Thank you very much to my friend, Daryl Murphy.
All right. Thank you, Jim. Thank you very much. All right. So, as I stated earlier, it's a network that helps us get together and to help us get these investment opportunities completed and done. So, I would like to first introduce. I would like to let him introduce himself, who helps us with our cost segregation studies and stuff like that, is Mr. Mark Gross. Mark, introduce yourself. Tell everybody what you're doing, how we work together.
Sure. Thank you very much, Daryl. Good morning, everybody. I'm Mark Gross from CSSI, for the largest cost segregation provider in the country. I'm Chicago-based, but I work on projects nationwide. I probably do more in Texas than any other state, not just multifamily, but all property types. For those of you who aren't familiar with cost segregation, what we do is our studies will identify what are the components within your property that can be depreciated faster, which will go against your income and thereby reduce your IRS taxes. So a lot of detail to cover in just a couple of seconds, but that's in essence what we do. I'll put my information in the chat if anybody would like a free preliminary analysis for any property nationwide, and hope to see some of you in Phoenix later on this week at Race Fest. Thank you.
All right, all right. Thank you, sir. Thank you. So, I don't see anyone else, any of our family members. I like to call them family members because we work together, but I don't see anyone else. So I'm going to continue to, and I'm going to move on. All right. Oops, right here. So the commercial multifamily masterminds, we do have a Facebook page. I would like to invite you all to please, if you're not a member, come on and join. Come and join the Facebook page. We do post news, updates to what's going on in the markets. We even broadcast live a lot of times on Wednesdays, that is, when we do the capital raise strategy session. So please come over, join. Just don't solicit on the page. That's all I ask. Please don't solicit. All right. Here's the GOB Network Facebook page. Please come over, join the Facebook page here. And because there's a lot of information here. Jim posts things, I post things, but come on over and join the GOB Facebook page. Then, if you would like to connect with me, come on over to LinkedIn and connect with me. All right. I would love to connect with you. So now when you do, put a little note in the note box, right? Saying where we met. This way I'll know who we are, or that is how y'all know who you are, right? And if you would like to join the GOB, right? Come on over. Come on over. You could be a sponsor. You could be a member. If you're a member, just click right here, fill out the information. Now, here it says your personal email. They don't want any type of school or business email. They want to be able to get in contact with you. We are referral based, and here they want to know who referred you to the GOB. Okay, and put the email of the person who referred you. Do not put your email or name. Put the person who referred you. Put their email. Okay, all right, and then finally, here we are. This is for everyone that wants a copy, all right, of today's broadcast. It will be right here. The broadcast will be posted. You could come here. You could look at not just today, but listen, go back. Take a look at the capital raise. Take a look at this commercial multifamily with Georgia Brew, and take a look at the one here with Ray Reyes. So we have a lot of footage here, especially underwriting footage and stuff like that, because that's what we're about. See, we got a lot of underwriting stuff. So please come on over, uh, and uh, and I could really use your support on the subscriptions. So please subscribe and help me get to 1,000. Help me get to 1,000 subscribers. All right. All right. So without any further ado, what I would like to do is tell you about our guest speaker for today. His name is Michael Morawski. He is a seasoned real estate investment professional with over 30 years of experience, managing over $285 million in transactions. An accomplished consultant, author, and public speaker, Michael has a rich background in residential and multifamily sales, investing, and property management. He has founded and led several successful ventures, including a private equity firm and a residential private management company, demonstrating exceptional leadership and entrepreneurial skills. Michael is deeply committed to social causes, having initiated a nonprofit to combat homelessness in Chicago, and is known for his strong work ethic, leadership qualities, and passion for helping others achieve financial success through real estate. His affiliates include Toastmasters International, BNI, Vistage International, and he has been a notable member of the National Association of Realtors and a National Real Estate Mastermind group. Let's all welcome Mr. Michael Morawski to the Commercial Multifamily Masterminds meeting. Mike, welcome. Glad to have you, man.
Thanks, Daryl. I appreciate it. That was a great introduction. Made me look around, see who you were talking about.
Well, listen, I know I left some things out, but please just take a minute and fill in some of the gaps of what I left out off the bio.
Yeah, you really didn't leave much out. One thing that I would say is I love what I do. I love the apartment business. I've been in real estate 30 years and got in the apartment business, and it's where my passion and my desire is. And part of that is a twofold mission. One is to improve the quality and provide safe and secure housing for my tenants. And the other side of that is to provide great financial benefits for my stakeholders and my shareholders that participate in our multifamily offerings. And those are the things that get me out of bed and drive me in the morning. And I have to say, Daryl, I love the slide that you put up by TD Jakes earlier about disruption.
Yeah.
Because I think that in this business, in this industry, especially in the market that we're in today, we have to be disruptive in order to get anything done. And that's not a violent kind of disruption, right? But
Right.
It is a disruption in thinking. And how do we think differently about what everybody else is saying and what's going on in the market right now? And how do we look at that environment differently today?
You know something? Everything you said is excellent, and I truly agree. I totally agree with you 100%. But that also now, let's get into what this is about, right? This is all about underwriting, right? This is all about underwriting. And I know we have a lot of different levels, a lot of different skill sets here. But Mike, let's talk about this. I'm gonna ask you this question right here. What are the fundamentals? What are the fundamental principles of underwriting in commercial investments?
Well, I think that there's three levers that we always have to pull, Daryl.
Mhm.
One is rent
Mhm.
growth. The second is how long are you going to hold that property?
Right.
And the third is purchase price. Beyond those, everything else is not as prevalent, right? But those three fundamentals or those three levers are the levers that tell us how the deal is really going to function. So you have to be able to, I love this story because I remember when I was in high school and arguing with my math teacher that there's no way I'm ever going to need to use this. I'm not going to use spreadsheets. I'm not going to have to, know all this math. And he would argue with me and say, yes, you are. And, it was funny because years later, I love math now because the math never lies.
Right.
And if you're looking at the numbers, um, you know, from a standpoint of what you're trying to accomplish. So, Daryl, I wrote a book, Exit Plan, right?
Right.
And in that book, I talk about thinking about the end first. And Stephen Covey in his book, Seven Habits of Highly Effective People, the second chapter in his book, which really got me engaged in thinking about the exit, was begin with the end in mind. So if I know where I want to go, how am I going to
Right.
get there? And my underwriting is my business plan because it talks about where, it talks about the three ghosts. And those three ghosts, if anybody has seen the play or the movie Christmas Carol, you've got
Yeah.
three ghosts, right? You got the ghost of Christmas past, the
Yep.
ghost of Christmas present, and the ghost of the Christmas future. And it's the same thing in underwriting. We need to look at the past historicals. We need to look at where we are presently, and then where do you want to go and where do you want to end? And we do that by looking at expenses, we look at income, we look at construction, we look at financing, all of those fundamentals that play into what's the return we're going to get for our investor.
Excellent. I like the fact that you mentioned about the three ghosts.
Hmm.
The past, the present, and the future. Because what are the things that underwriters or people who are getting into real estate, what are the things they're going to need so that they can see the past, the present, and the future?
Are you asking that as a question?
Yes.
Okay, so what are the things that somebody's going to need? We're getting ready to close another deal in Tulsa this week,
Right. Okay.
and it's been a while since we had any updated numbers. And what I want to look at is I want to look at a current rent roll, and I want to see if there's been any changes in that rent roll from the last time we looked at it till today. I want a current T12 so that I can look at the expenses on the T12, and I want a current T3 because the T3 is going to give me a real-time snapshot of where the revenue actually is, where's the income actually coming in. Then I want to look at any housing reports. Do we have Section 8? Do we have county or state housing in that market? And I want to look at those reports and see who's paid and are they current with their share. I want to look at a delinquency report. So those are the key things that I want to look at prior to a closing or prior to my underwriting event. And I look at underwriting as an event.
Right.
We have to go through that exercise in order to see if it's worth burning the calories to close the rest of the deal.
That's, and I definitely understand that because when I get into my underwriting, I'm looking at my rent roll, I'm looking at that T12. And I'm gonna tell everyone here, I think underwriting is the most important thing. I think it's even more important than capital raising. And I'm gonna tell you why. Because if you can't underwrite, you're not getting no capital anyway. You know what I'm saying? You're gonna either overpay and lose people money if they give you the money, or you're gonna be so low you're not gonna get it anyway, right? So so Mike, let me ask you this: before you even start your underwrite, how do you pick your market? How do you know where? Because you said you're in Tulsa right now. You get ready to close. How did you pick that market, Tulsa?
Huh. Boy, that's a big question. Um, so I'm a market-driven investor. I always have been. You know, I think there's some market traps that we need to watch out. There's
Okay.
probably 8 or 10 of those market traps that I need to be able to check the boxes before I even look at the deal. You could bring me a great deal in Chicago, and I already know that I can't check the boxes in that market. But you
Right.
could bring me a questionable deal in Dallas or Atlanta or somewhere else where I can check the boxes in the market. And those boxes are population growth. You know, I need to see a positive incline in population. I need to see a positive impact in job growth. And job growth is directly affected by population growth. And
Right.
then household income. And household income is directly affected by population and job growth. So why is household income important? Because as a landlord, I want to be able to raise my rents. But if the household income in the market, and we all have to remember that markets are not just a macro effect, but they're a micro effect because you have a sub-market. If you look at a market like Tampa, Tampa has 15 sub-markets. Chicago has 78. Who knows how many are in New York, right, Daryl?
That's right.
So you have to look at the submarket. But I think one of the most important fundamentals, and I learned this years ago when I was in markets that didn't have a big employment diversification, you need to be in a market that has a high employment diversification. I almost think that should be number one on the list because the employers are what keeps the market growing. So if you're in a market that only has one or two, like years ago, I owned real estate in a couple of tertiary markets, and the employers in those markets were transportation and auto manufacturing parts. And
Right.
when the economy got hit, both those industries got wiped out. And so people lost their jobs, people moved out of apartments, there were challenges. But if you're in a market that has multiple employers, let's talk about Tulsa for a minute. In Tulsa, we have aerodynamics, we have medical, we have education, we have retail, we have entertainment, we have distribution, we have technology. And I could go through a list of 5 or 6 other things where it's causing the market to expand. So it's an emerging market. I like to say Tulsa right now. We're in Tulsa before the smart money gets there, because as soon as some of the smart money starts to realize Tulsa's fundamentals are important, they're going to start to go there, and we're going to see even a bigger boom. So if you're looking to position yourself in front of the next bull run, look at markets that are emerging. And I have a complete list of those traps. If somebody wants a list of those, you could direct message me, and I'll get you a copy of that.
So you mentioned, my first deal, the very first property I ever got under contract was in Tulsa, Oklahoma. 208 units. That was my very first property that I got under contract. I didn't close on it, but I got it under contract, 208 units. Sure enough was. But you mentioned some key indicators that I also look for. Population growth, household median household income, job growth. You mentioned the same things I look for. But can you tell us what percentage of job growth do you look for? What percentage of population growth do you look for? Can you give us some insight on that?
Yeah, Daryl, when I look at population growth, I want to see something over 0.5% a year in population growth, but not just this year. I want to see what the history's been, right?
Gotcha.
So when I first looked at Tulsa and my underwriter brought me the deal, I said, hey, I have no interest in that market. And my underwriter said to me, he goes, you need to look at this market because the fundamentals are sleeping and they're strong. So we started to look, and there was a 5 or 6 year trend of the population growing at about 0.7, tenths of a percent,
Right.
right? About 0.75% year after year. And then all of a sudden it exploded in 2022. So the population had grown. And the reason for that was, here's what drove that, was the city of Tulsa said, hey, if you're a tech worker and you want to work from home, we're going to pay you $10,000 to move to Tulsa, live here, and work from home. They ran out of money and still had 1,500 people move there. So, those are the types of trends that you look at and you go, there's something going on here. Then you see manufacturers starting to build. So Canoo, a brand new electric car manufacturer, is building their international headquarters there.
Right.
American Airlines is hiring 300 jobs over the next 18 months. The airport is just doing a $3 billion expansion for international flights.
Whoa.
There is a theme park being built outside of town that is going to rival Disney. So when you start to look at these things that are happening around
Right.
you,
Right.
go, well, there's something bigger than me going on there. And then as far as job growth goes, job growth is going to trend with population growth. And, if you watch those trends, that's where the magic lies.
Fantastic. Fantastic. Let me I want to do one thing. I see your hand, Mr. Jarman, but I want to try to get through some education here. Mike, I want to jump back a little bit, but this is because I want to start getting more into the nitty-gritty of the underwriting. Would it be okay if I shared a rent roll to show everybody what a rent roll look like, Mike? Would it be okay with you?
Sure. Yeah,
Now
absolutely.
this is old, everyone. I'm not showing you this is a old sample. Okay. Oh, yeah, that's the rent roll. So I just want everyone to see this is what a rent roll looks like. For those who are not familiar with a rent roll, I'm sure a lot of you know, but this is what a rent roll looks like. So, Mike, I just want to ask a couple of questions. Let me do this right here too. I want to bold this out. I just want to get into a little bit of this right here. I want to make this here yellow. So that way everyone can see. So everyone, what I'm doing, this is yellow. This particular unit, this particular rent roll has 454 apartments, and it has 39, currently has 39 vacancies. Now, if you do the math, you'll see that it's still greater than 90%. That's what you get when you get a big apartment building, 454 units. But Mike, when you're looking at your rent roll, beside the vacancies, do you look for how do you take NTV's notice to vacates? Do you also look at them in a way of saying, yo, I'm going to count them as vacant, or how do you look at your NTVs?
So there's two ways to look at your income side, right, Daryl? And just I had to move that over to the other screen. So if I'm looking away, it's because I'm looking at the rent roll, but my eyes aren't that good to see it on the small screen. So
okay.
There's two ways to look at your income, right? Or look at your vacancy, occupancy, however you want to term that. The first is physical. So who actually lives there and is paying you or not paying you, right? So there's physical vacancy, but then there's economic vacancy. And so my NTV is going to come up as an economic vacancy. So if I have 10% physically vacant, So let's just say I have 100 units, 10 people don't live there. That's 10% physically vacant, right? Um, if but if I am losing income on another 5%, I'm actually 85% economically vacant. I care more about the economics than I do about the physical vacancy. Because Daryl, you could live in an apartment and just not be paying rent. You could have had a notice served to you or not had a notice served to you. Housing could be behind. There's a lot of factors that go into that.
Okay, that's interesting. Because you said you look at the economic vacancy more so than what's actually vacant, and you're absolutely correct. Um, a lot of times, what I do, I depending on the date of the notice to vacate, and also depending on if they're going to renew. Sometimes I will count them as okay, I'm as continuing on or whatever. But do you when you averaging your rents, like and you're putting this into your spreadsheet, do you look at do you average uh the rents by, say, looking at the move-in date? Do you get your pro forma numbers from either the move-in or the lease from date? How do you get your numbers, such the average numbers, current, and your pro forma numbers?
Uh, two ways to look at that. The first pass, I just
Right,
want to see if that deal is going to make sense for my investors. Am I
right,
going to hit a threshold of upper teens return on an IRR? So I'm just going to look at my averages. But once I decide that I'm going to, you know, that I want to pursue the deal, now my second pass is going to be to extrapolate the data from the rent roll and put it into my underwriting tool,
okay,
because that's where I'm going to get my actual rents from. So I'm going to see what my averages are, and I'm going to see, you know, hey, a lot of times a broker is going to bring you a deal, and I don't know if there's any brokers on the call, but a broker's job is to sell the deal, right?
that's right,
So they're
that's
going to
right,
exaggerate a little bit. I want to see, hey, look, it looks to me like that average rent on that rent roll, Daryl's probably somewhere around 825 a unit. But all of a sudden, if I see that somebody's popping out at 840 and 850 and 860, are
right.
they really achieving that rent? That's what I want to know. So a detailed look into that rent roll is going to help you determine that. And again, it's not just what happened this month, but over the last 3 months, because you always pull your income side from a T3.
Got you, got you. So now, everyone, if you're wondering, what is Mike talking about when it comes? He said, "Wait a minute, you should pull it from a T3." He probably saying, "Well, what? Okay, now what is a T3?" Mike, is it okay if I share a T12 so that they could get a view of how to calculate a T3?
100%. Now,
Okay,
you can, if you're in a financial vault for a broker and you're pulling financials, they should have a T3 broken out for you. If not, I would go request one um, on that, because that's a great way to compare your numbers. So um, your T12 is the trailing 12 months. Your T3 is the trailing 3 months. And the reason that you want the T3 on the income side is because it's real time. And
right,
if you look at the trends on here, just look at the net rentable income. You can see it trending up, right? So we're going
right.
in January of 23 from 352 up to 384 in December. That's a nice trend. It shows that they've really done some things to increase revenue, which when we increase revenue, we increase value. But if you took October, November, and December's numbers and looked at those on the income side and looked at the rent roll for those 3 months, does all that line up?
Got you, got you. Okay. Okay. Now, since I have the T12 open, when you're looking at that T12, what are you looking for? What are you looking for on that T12? What are you looking to hear that T12 to tell you?
So on the T12, it's going to be expenses. So if you scoot down, Daryl, I'm going to start to keep going down to where our expenses start. So,
Right,
you've got two kinds of expenses always, right? You've got controllable and non-controllable.
exactly.
And I want to break those out, right? And I want to look at what's controllable, what's non-controllable. Taxes are really non-controllable. And
That's true.
unfortunately, these days, insurance is non-controllable also. Because insurance is just continuing to go up. And but controllable expenses are your payroll. They're going to be your office expenses. They're going to be, administrative costs, things like that. So I want to look at both sides of that line. And I want to see if there's anything that jumps out to me that says, so, hey, look, Daryl, if you look at bank charges, in January, we had $15 in bank charges.
Right,
But in what appears to be November, we had $1,300. Why?
right.
I want to know why. So I'm going to, those are questions I'm going to pull out and I'm going to ask ask the broker.
Right.
Give me some data on this. I need some context around this. Um, go down a little bit more, Daryl. So payroll, you know, he's got he's got a $500,000 a year in payroll. Daryl, tell me what was the annual effective gross income? 5
Right
million.
here. Yeah,
So we're
5 million.
about 10%. So rough numbers say we're about 10% on payroll. I like to be somewhere between 9 and 11% on my payroll when
Okay.
I'm looking at it, especially when
Right,
I'm performing, you
right,
know. An easy way to back into that is depending on the market you're in. What is what are you going to pay for a leasing agent? What are you going to pay for, could be 50, $60,000 a year. How many employees do you need? You have to start to look at, okay, I think you said this was 480 units or something.
yeah, 454.
I probably have 8 or 9 employees on this property.
Correct.
Right? So
Yeah,
now, simple math says if I back in at $50,000 or $60,000 a year, including taxes and insurance for employees, that 10% factor of my EGI is pretty good.
right. Wow. Let me, I'm
And
trying to take this here off of here. Go ahead. I'm sorry. Go
EGI
ahead.
is, yeah, I just want to just say to anybody who might not know, EGI is effective gross income. And we get to EGI or effective gross income from our market rate rent that comes in, any vacancies, concessions, bad debt that comes out, other income added back in, other income being amenities or things like parking and vending machines and application fees, things like that. Add back in your other income, and now you get to effective gross income. Effective gross income is what you have to pay your bills with.
Correct. You're absolutely correct. Mike, do you look at how do you look at your late charges and the NSF, the non-sufficient funds? Do you account do you let that ride on yours? That like this big 142,000, or do you reduce that because your goal may be to reduce it or get rid of it?
Yeah, I'm usually going to move that to bad debt, to loss
Oh,
to lease. I'm not going to move it to bad debt, but I'm going to move it to loss to lease. And then my goal is in the first 36 months to burn down the loss to lease number. So I have a function in my underwriting tool that allows me to do that. So I can take bad debt,
yeah,
right? Or loss to lease. So, And loss to lease is this. If I have my rent at $1,000, but I'm only collecting 900, that's a loss to lease number for me,
Correct.
right? Um, if I have NSFs and things like that, those are that's loss to lease for me. And I'll move that to that column, and then I'll try and burn it off. And I have a function in my underwriting tool that allows me to do that. So I can go in and manipulate the number over 36 months to lower it, which again, your goal as an operator should be by month 24 to be fully to have fully made the transition of stabilization, capital improvements, tenant turn. So by the end of 36 months, you should be able to have zeroed out your loss to lease number.
That is, something? I've never even thought about that. Never even thought about it. What I normally do, since I know I'm trying to get rid of it, I mark it as red, right? I mark it as red, and then I will, when I input my other income on the T12 side of my model, on my 1 year side of my model, I will subtract that 142. But what you just said, that makes sense.
So Daryl,
Because
you have my underwriting tool, right?
yeah,
Okay.
I
So
took your class.
yeah, so write this down for yourself. Um, on the underwriting tool, if you go into the tab on the bottom, that's 36-month renovation tab,
Right.
and you go to line 90, like A90,
Yeah.
there's a little blue number there that you can manipulate. And your goal is to manipulate that number to by year 3 to be at 0 or as close to 0 without going negative on your loss to lease. So that's just a little trick on how to do that. And what that will do is that will show you, 50 to 75 basis point better return on your investor returns.
Wow. That is interesting. That is a
And,
good nugget right there.
and here's the thing about that though, is you're not manipulating rent. You're
Correct.
just you're just multifamily is a business that you buy and you make run better. You create value in that by making it run better. It's giving better service, better product, better, everything to your stakeholders and shareholders. And if you run that business better, you are going to make more profit for your investors.
Gotcha. So I don't want to listen, everyone. I know you're probably thinking, "Wow, Daryl is gonna monopolize the whole conversation." No, I'm not going to do that. But there are some questions that I wanted to touch bases on, especially when it comes to underwriting, especially when it comes to the rent roll, especially when it comes to the T12 and stuff like that. So if you have a question, if you're afraid to come off mic, just if you're afraid to come off mic, type it inside the chat. If you would like to come off mic, raise your hand and I'll call on you. Mr. Jarman, what question you have?
Yes, sir. Yes, sir. How's it? Number one, how is everyone doing this lovely day?
Hey,
Mike,
fantastic.
here's what I'm looking at, Mike. Mike, we're talking about the market. What you said is that, yes, the growth is number one because that sort of fuel the rent and et cetera. But what I've noticed, Mike, is that across the United States, perhaps the major big city, Houston, Texas, Raleigh, whatever, uh, are good investment areas. However, here's the question. The small town, what I'm noticing is that in the small towns now, what they are doing now, they're pouring a lot of money into small towns. What do you think about now? We talk about it could even be smaller than tertiary market. So if you can find a market where the But Metropolis is putting a whole lot of money into the area, bringing in a whole lot of other business, but the employment is not where it should be. The rent is not where it should be. But if you can find a property that is cash flowing at that particular time, will that be a good area to invest in?
Hey, James, great to see you again, by the way.
Thank you.
And that's a great question, right? I think there's a couple of ways that we can look at multifamily. What do you want to achieve? What are you looking to achieve? So we can provide cash flow, we can provide long-term wealth, and we can provide tax planning strategies. Now, those are the three things that multifamily will do for you and for your investors. What do you want to accomplish? You know, I'm the kind of person or investor that likes to do all three of those. I don't want to just have cash flow. So the reason I never invested in Chicago is because Chicago's a high cash flowing market. You know, you're gonna clip a coupon, but you're not going to get the appreciation. I want to be in a market where I'm not only going to get a coupon, but I'm going to get appreciation. Because when you look at putting your return together and you want to get a solid, stable return from not only cash flow, but from appreciation. And that's what I deliver to my investors. So if your goal personally is to create cash flow for yourself and for your investors, there's nothing wrong with being in that type of a market. But if your goal is to create cash flow and appreciation, then I would look at a different market.
Gotcha. Cool. Thank you.
All right. Alicia, go ahead with your question.
Yeah, so I dropped some of them in the chat. Mike, when you were talking, it prompted me to think about risky investments. Have you ever invested in risky investments? If so, why? And if not, why not?
Why do you always ask me hard questions, Alicia?
Sorry.
I have invested in risky investments, and some have worked out, some have not. You know, I think risk is evaluated through the underwriting process, and we evaluate risk and what level is risk. There was a time in my life that I was a 10 on the risk scale, that I took higher risks in tertiary markets that didn't have good fundamentals. And today my risk tolerance is a lot lower. You know, I want to create a deal today that is going to be profitable for everybody. So I'm not going to do things that are going to accelerate returns in markets that aren't performing, where I'm taking a shot on. I'll give you an example. I bought a property one time in Connersville, Indiana. Connersville, Indiana is about 35 miles outside of Indianapolis. It's in the middle of a cornfield. And you might say, why are you buying a property in the middle of a cornfield? Couple of reasons. One is it was all 3 bedrooms, 2 bath. It was owned by a mom and pop seller who built it, owned it for 37 years, and the rents were about $250 on average below market. Mm-hmm. Then economically, they were building a super Walmart across the street from the property. I knew that that would be a 3,000 job increase to the marketplace and pull a big chunk of my property taxes. So, and then they were building, which never happened because this was pre-2008, but then they were building a projected to build a carbon engine manufacturing facility outside of town for police cruisers. And that never transpired. But so, yes, there was risk, but it was more of a calculated risk at that point because I knew what I could do fundamentally with the property. And then if Walmart did this, And if this manufacturer did this, it was just more of a benefit. That was probably one of the best cash flowing properties I ever owned. So that was a risk that I took that made a lot of sense. But then I bought a property in Anderson, Indiana. Anderson, Indiana, at the time I bought the property, was #1 in the country according to Money Magazine to raise a family in out of their top 250 list. 2008 came around, it got pummeled and dropped to #4 from the bottom. And we got wiped out in that market. So that was a risk that didn't work out so well. So I think you have to evaluate your risk tolerance. What are you willing to risk? And I always remember today that it's not my risk, it's my investor's risk.
Right.
So I'm not doing this for me. I'm doing this for my investors.
That's very important. You had also mentioned earlier in the call smart money, the term smart money. Can you expand on what that is?
Yeah, that's your hedge funds, your Blackstones, your Praxis Capital, that is Ashcroft. It's the big players in the marketplace that are either buying existing stock or they're going to go in and do some development product and change the fundamentals of the market.
Awesome. And then one last question for me. Have you ever worked with and purchased properties that did not readily have a T3 or T12 available? And then if so, what did you do in order to underwrite that investment?
So we're dealing with a seller right now who 30 years I've been in this business. It's probably the worst operator I've ever dealt with. Terrible business owner, has no documentation, no records. Everything he's done, he's manufactured on an Excel spreadsheet, and we've had to re-engineer everything. So if you have smart people around you, and I'm not one of those guys, you can look at anything. So what I would do is I would get an experienced person like Daryl or yourself, Alicia, and I would go in. If you're a newer investor, um, get as much data as you can and manufacture what you have to manufacture. You might get leases, and what are they, and then a bank statement or a tax record or something that will give you some simulation of the numbers. But it's funny because I write in my book, I say, if you have an owner that is giving you numbers on the back of a cocktail napkin, you probably should run in the other direction. And it's, I need to follow my own advice sometimes, but here's what I know too, doing these deals in Tulsa that we're doing right now, with the lack of data, we found a lot of dead bodies along the way, and we found a lot of places that we're really going to be able to increase the revenue. So, it goes back to some risk, but you give and take where you need to. So.
Yeah. And then Daryl, Preston and Karen
Yep,
also
I got that. Yeah,
okay.
I got it.
Awesome.
All right, cool. So I'm gonna speed through some of these questions here, and so that we could wrap it up. So Preston asked, can you define submarkets, please?
Can I define some markets?
Yeah, a sub market. Define sub markets.
Well, it could be like a zip code. So if I look at Chicago, in Chicago, there's 78 zip codes that are all their independent submarkets. They all have neighborhood names. Tampa's kind of the same thing. They're all submarkets. They have different neighborhood names. And what you want to do. So I'm going to talk about Tulsa for a minute. Tulsa on a whole, the household income in Tulsa is $78,000 a year. But on the east side of Tulsa, in the submarket I'm in, the household income's $43,000 a year. So you can break it out by quadrant. You can break it out by zip code, by county, by township. You can, I always say Google's your best friend. So you can start there. But let me give you a website that will help you with demographics, household income. It's a free website. It's called justicemap.org.
Justice Map. Yep.
It's a little finicky to try and figure it out, but once you figure it out, it'll give you demographics, household income, population, some growth statistics. And then there's always citydata.com or city feet. Those will give you some good data statistics. And that's free data, right? You can get crime data statistics, that's free. You can get demographic data statistics, that's free. But then if you're dealing with a broker, ask a broker for the CoStar report for the fundamentals that you want in that market. And that's paid data. Most of us, I don't even pay for data, but I have friends that do, and I go to them and get a little bit of help when need be.
Excellent. Karen asks, would all the T3 info be included in a T12?
Yes, typically yes. But if they ran the T12 in November and it's January, it's not current. But if you can get them to run a T12, a T3 for today, it's real time.
Gotcha. Carly, let me see, Carly's still here. Carly asked, where do you find what is coming to an area?
That's a great question. I'm glad you asked that, Carly. You go, so there's a couple of things that I always tell people when you're doing due diligence or even early evaluation stage. First of all, when you look at the crime, don't just believe the crime report, call the police department or walk into the police department, walk into the fire department, see how many calls, try and pull a call log and see. I bought a property one time that would have saved me a lot of aggravation if I would have just went to the police department and asked for a call log, because after I took possession of the property, I found out that the police were at the property 27 times a month for domestic disturbance disputes, which is a perfect month in February, right?
Yep.
And so, get the data. But if you go to the city hall, to the economic development department, they always have maps. So they have a 5, a 10, and a 20-year plan. Every city does for growth. And you want to look at your property on that plan map and see, am I in the path of progress? What do they expect for this area? What do they want in this area? Hey, I bought a multifamily deal in Florida one time, and I bought it really in a residential neighborhood, but there were these two pieces of land that were on the highway like 2 blocks away, and they were slated to build shopping centers. And I knew that they wanted to have some anchor stores like Starbucks and Panera and some anchor stuff in there. And so I knew that property value was going to go up because of the commercial increase in the area. So go to the economic development department, ask them what is slated for that market, for that submarket. Go to the building and zoning department and see if there's any violations on that property. we just bought a property. This is kind of a funny story. We just bought a property. The fire marshal showed up because of an incident that happened at the property the day after we bought it. And they had just served the old owner 27 violations 30 days before that they didn't make us aware of prior to closing.
Wow.
So
Holy smoke. That's something. So listen, I done kept you 1 minute past the hour, but Mike, you threw out some, some people say gold nuggets, right? I don't like saying gold. I like saying platinum, right? Because platinum I think is higher than gold, right? You threw out platinum nuggets. You gave a lot of information. If y'all new to investing, if you're new to underwriting, I think you learned a lot today that can help you in your underwriting. Right now, I'm going to ask Mike this question right here. Mike, if anyone wants to contact you and get and reach out to you, how can they do so?
yeah, thanks, Daryl. So I put my information in the chat. I love networking. I love talking to people. So you could call me, text me, email me, whatever works for you, but I'm accessible. I want to be accessible and help if I can. You can follow me on any social media platform that you hang out. And, we're always putting out content to help people. So whatever stage of the investment business you're in, if you're a capital raiser, I'd love to talk to you. If you are new in the business, I love to talk to you. So makes no difference. I know that there's a handful of people on the call that I know, that I've seen, that I've talked to in the past, and a bigger handful that I haven't. So I welcome that. And if anybody's going to be at Raise Fest, I know Mark mentioned he was going to be there, and I don't see him here anymore, but I'm going to be in Raise Fest the rest of the week in Phoenix. So if you're going to be there, text me and let's circle up for a cup of coffee.
Fantastic. I asked Alicia if she was going to go to Raise Fest because she lives in Phoenix. So are you going, Alicia, to Raise Fest?
I am not. This is the only weekend that my cousin is coming out, and it was planned months ago. So I'm not going to even be in town.
Oh man. Okay. All
Yeah.
right. All right. Well, listen, I want to say, Mike, thank you again. And I do need to reach out to you. There's a property that I'm looking at in Oklahoma, and I'm looking for a property manager. So I would like to get in contact. Maybe you can help me find a property manager in Oklahoma.
Okay.
All right.
Yeah, we can chat about it. Yeah. So don't
Sounds good.
hesitate to reach out, Daryl.
I definitely will. Listen, everyone, I want to thank you all for coming out.